So we understand that crude oil has this overall resistance support level according to this trend line. So we need to take that into consideration. For the month of February, for bullish entries, I would believe that if you want to make sure that you are completely on the bullish side, I would believe that we will have to see a break above the 61.8% Fibonacci retracement zone, and only then we can consider the black gold crude oil. It's basically 33 level. Let's take it like this: 33 level. Above that level, we can consider crude to be on bullish side. And the bullish side that we are talking about, or the bullish entries, should not be too much on the move towards the north, but it should be first finding its resistance, direct resistance at 38.2% Fibonacci retracement zone, and that's the $35.77 per barrel. And you can see that that level is anyway overall a major resistance level, for mostly due to this one candle. If I zoom in a little bit, you can see that. I'm referring to the candlestick of 21st of December 2015. So that being said, it's a very important resistance level. Okay, so therefore any bullishness that we would have will have its limitation at 38.2% Fibonacci retracement zone, and that's 35.89 level overall. And it's also coinciding with the 50-day moving average. If we go on daily time frame, because at the end what I just told you is about swing entries. So on daily time frame, we have a couple of extras right now. First of all, we see that the pair or the commodity is trading between two moving average. That means that this is a level that we generally try to ignore for the fact that it's mostly sideways development. But so far today it has been quite southward, bearish, bias-based movement. So I believe that the first bounce that we will see for today or early tomorrow will be at 31.20 level, and that's going to be the scalper's paradise, that you can take small advantage of the bullish side or small corrective waves, but try to stick to 35 to 50 cents movements only, because that's going to be just that much, at least, that we can think of. Furthermore, the main bullish entry that you should be aware of will be the 161.8% Fibonacci retracement zone, and that's at 24.20 level, more or less 24.25 level. And if you manage to catch crude oil at that level, just buy it and keep it until 38. So that will give you as much as 1,100-1,200 points, and for crude oil, that's just a gigantic opportunity. If you enter with one lot, if your equity enables you, you can just make well above $11,000-$12,000 opportunity in just one lot trading of crude oil from 24.25 level. So let's go back to USD Canadian dollar now. First of all, you need to understand for USD Canadian dollar that this is a pair which is heavily correlated with the crude oil. So anything happening to crude oil has a direct impact on Canadian dollar. So that being said, when we look at the pair, we see that the Canadian dollar has been depreciating for the last almost 2 years, a year and a half, for the fact that crude oil has started to fall. And of course, it's also because of the fact that the US dollar has been appreciating. So you need to also understand the correlation between the US dollar and the crude oil. Because the crude oil is quoted on US dollar, strong dollar will always mean cheaper crude oil prices. And that's very important factor which is being ignored by many analysts. So if we see that, if we see any kind of depreciation for US dollar in February, which is quite possibly, it's quite possible for us to see some depreciation on US dollar in February. That would probably mean that we would be seeing some negative impact on crude oil. That would mean that possibly maybe even this week on for the NFP figures, we could see that the crude until then dropping down to 28.90 level, which is 110% Fibonacci retracement zone. And after the NFP, we could see possibly the reversal from just $28.92 per barrel level. And if that becomes the case, we basically then should be expecting the USD Canadian dollar to again until then appreciate up to 61.8% Fibonacci retracement zone, and that's 1.4265 level, and from there onwards start going downwards. My personal target for USD Canadian dollar at this given moment would be to short it between 1.4265 and 1.4465 levels, basically 88% and 61.8% Fibonacci retracement zone, and to target at least 10% Fibonacci retracement zone, or even the 0%, and that would be basically that 1.38 level that as our target. In the meantime, we will definitely have some correction on this pair this week, so you can consider longing at or close to 1.3950 zone, and your target initially should be right on the 38.2%, which is at 1.4082 level, and again short from 1.4465 or 1.4265 level. So these are the potential short levels that we will be looking for. Let's go to Japanese yen. One important thing that you need to understand about Japanese yen is that it is a currency that's always being manipulated. Just like last week, the Bank of Japan decided to lower their interest rates to negative zone. So we can always see some kind of strange things happening or strange actions being taken by the Japanese Bank of Japan or Japanese Central Bank. So I'm not quite surprised. So any global recession we might see would mean that the Bank of Japan will start taking drastic actions. So when you see that China is going into recession and suddenly the world is looking for safe haven assets, that would mean that people will start buying the Japanese yen, and suddenly you would see that Bank of Japan would drop a bomb in the market, and they would try to depreciate the Japanese yen. It's due to the fact that the Japanese economy is still in depreciate, or it's still in a level that Japanese central bank considers to be in recession. Okay, and it's because of the fact that the country is in deflation. Deflation is the opposite of inflation. So what it means is that if you ask an ordinary Japanese person, you would see those people not buying certain products, believing that the next month it will become cheaper. So it has been already many years. I believe it has been from early 2000s. So since then, it's it's close to 15, 16 years already now that ordinary Japanese believes that by not purchasing things this month, they can buy it cheaper next month. And this has led the whole economy go into deflation zone. And indeed, the stores and so on are doing it. They often have these campaigns that they make prices cheaper and so on. So this is what bothers Central Bank of Japan or Bank of Japan. And on the other side, you know, the world is going into another recession. It is inevitable at this given moment. And whenever the world goes into recession like we are heading now, every investor out there would consider Japanese yen as a safe haven asset to have. They would rather to keep the Japanese yen and the Swiss franc than any other assets out there, and we would see some collusion here. So let's look at the pair now. We first need to define our Fibonacci wave. I guess this is the one. Okay. Let's actually take this one. So I actually took an inverse Fibonacci wave over here. If you have been joining my other Fibonacci trainings before, this is the inverse version. So back to daily time frame, we can see that this level is indeed this wave that I took over here is indeed a major Fibonacci wave for the fact that it has acted and reacted to 61.8 and 38.2% Fibonacci retracement zones. And at this given moment, the pair is finding itself a resistance at 61.8% Fibonacci retracement zone. And that's 1.2170 level, more or less. If you look at the pair closely at that level, you would see that this is, well, let me zoom out so that we can see the big picture a little bit. We can see that this is the level that that has been a very important support and resistance level. Back in the first quarter of 2015, this level acted as a resistance. Then it broke out in May 2015. Then it again became as a resistance in August 2015. As well as in October 2015, and at the moment the pair is finding its resistance once again on it. So this is a very strong resistance level for this given pair. So if you are going to be trading, this pair, you need to make sure that if you're going to be looking on a bullish side, you need to make sure that your market price is above the highest high of the Friday's entry or Friday's candle. And Friday's highest high was at 121.69. So look for 121.90 or 122 levels for you to confirm that the market is going to be on a bullish side. That's at least what I would try to look for. And the targets that I would take for this pair would be initially at 123.30 level, which is 38.2% Fibonacci retracement zone. And maximum I would consider would be 125.00. So that would be the two targets that we would have. If we go on hourly time frame, we would see this even stronger. So at this given moment, I would actually also consider long in this pair from 120 level. It's for the fact that 120 level is at 88% Yagub's custom Fibonacci retracement zone, as well as it is a psychological support level. So from here onwards, we could possibly aim for 61.8 and 38.2% Fibonacci retracement zones. So we are looking for more or less 300 pips of profit opportunity that we could take in February from USD Japanese yen. Okay. The next part that we're going to be looking for will be the cable, GBPUSD. And if we look at it, I've basically taken the Fibonacci wave of the last week of December and the second week of January, more or less. And looking at it, we can see on daily time frame that the pair found itself a major support at 110% Fibonacci retracement zone. It's a custom level, okay? So I always trade these levels, so that's why we have it. And that's also the reason why I asked my followers on Friday, or I basically shared my own analysis on Friday, that we bought GBPUSD at 1.4170 level. While everyone was shorting, we were actually buying it. And indeed, that's the reason why we have now more than 210, 220 pips of profit so far. Now I'm going to be sharing my possible exits for it. I will be looking forward to exit my current GBPUSD long positions at 1.4410 level. That's going to be my targets to exit. Maybe even we could consider it now. And this is going to be for the fact that we will basically close the position in order to look for another long position at 1.43 level. And this is for the fact that, you know, I believe the market is going to touch there and it's going to find some kind of small resistance, like 100 pips, and then it will start moving on a bullish side again. However, though, if you want to keep onto your long GBPUSD, our targets will remain at 1.4670 level, and that's 38.2% Fibonacci retracement zone. Or before then, we could have a major resistance level at 1.45 level. It's for the fact that this is 61.8% Fibonacci retracement zone, and also it is considered to be a psychological resistance level. On hourly time frame, you can see the reason why I say that I will consider exiting my pair at 1.44, and the reason is quite simple. I can see a triple top formation for me, and basically 1, 2, and this is going to be the third one. That basically means that the market is going to find itself another resistance. However, though, if we end up at a situation where we wouldn't really have this formation making a high of 1.44 or maybe even a little higher, that could possibly mean that the market or the price action is not quite there yet, and we might have a bearish formation. And if that is the case, we will start looking at possible long opportunities at 1.3999 level, or in another word, 1.40 level. If we ever see this pair at 1.40, I suggest you entering on it and do not exit it. Try to make sure that you don't risk your entire account on it. But if you catch the pair at that level, hold on to it, because you will easily be having well, at least 500 pips profit. That's going to be the target. Basically, you enter 1.40, you would be exiting at 1.45. Even better than that, you could even look for the possibility of going for 10% Fibonacci retracement zone. So this is the opportunity for cable. Now we are going to be looking at euro dollar. Euro dollar has been our naughty boy for the last well, more or less 2 months now, a little less than 2 months, for the fact that we can see that the pair basically moved in a narrow case of 1.10 to 1.0770. So this is the level that this pair has been moving for the last 2 months. And when we put it on Fibonacci as well, we can see that it found itself a support at 38.2% at 1.0730 level, and it found itself a resistance at 88% Fibonacci retracement zone at 1.098 level. So we definitely need to see this pair breaking above or below these levels. And furthermore, we have these trend lines that I've drawn. So it gives us another opportunity to look at this pair. Okay, so I believe if you want to long or short, my suggestion or my preferences at this given moment would be to stay away of euro dollar overall, for the fact that although the media is trying to paint it that the US economy is doing great, actually it's not doing great. It's quite in a shitty environment, for the fact that just today the debt of the US government hit $19 trillion all-time high. So that's an alarming level. Although the Fed has the power of printing money all the time, it still doesn't mean anything. So we are looking at the possibility of the US dollar depreciation, for the fact that today we saw the first time ever in history the US debt going above the 19 trillion. So on the other side, Europe is not doing well neither. European economy is troubling at the moment. And European Union is being troubled by the refugee crisis still. They are even locking down the borders and so on. So it's quite an alarming scenario, and some politicians are going even over the border and commenting that they see the Schengen zone coming to its end, which is quite possible right now. So what we are going to be looking for at this given moment is that we would be considering, I repeat again, we would be considering, may the odds be in our, may our strategy reach the consensus, we could consider to long above the 1.0930 level, or to short below the 1.0830 level. So we give basically the market 100 pips of side range, and we will be considering to long or short after these levels. If you're going to be longing, your initial target will be at 1.1050 level, which is 100% Fibonacci retracement zone, as well as 200-day moving average. If you're going to be shorting, may the case be that the pair will break below 1.0830 level. Your first initial target will be at 1.0770, because it's the most important support level so far. And if that level is also broken below, your next target will be following to 10% Fibonacci retracement zone, and that's going to be 1.06. And I don't want to think of way too much negative, but possibly we could also see 1.0470 level. This is for euro dollar. I don't like talking too much about euro dollar because of the fact that I have my personal feeling for it. I live in Europe, therefore most of my savings are in Europe, for the fact that my banks stopped giving me the US dollar savings accounts and so on. So I have a feeling, and therefore sometimes when you have a feeling for a specific thing, or when your brain wants to see the positivity on that thing, you tend to make a wrong decision. So that's the main reason why I don't really trade euro dollar for the last, I don't know, 2 years, almost 3 years now. Now we go back to our final tradable instrument, and that's gold, the safe haven asset. The main thing that the gold has ahead of it is the fact that the US Fed decided that they will be hiking the interest rates. So when the interest rates are hiking, we could possibly see the gold to depreciate a little bit, just a little bit, not too much. Meanwhile, if we look at the yellow metal from price action and an overall Fibonacci point of view, we can see that it is on a bullish run. It is making a higher high and higher low. Moving average, one of it, 50-day moving average, has turned its slope upwards. So the price is above the 50-day moving average, although it's below right now the 200-day moving average. I suggest that, well, I expect, not suggest, I expect the pair to make a high within the next couple of days to the level of 38.2%, which is at 1,140 level. That's quite an expectable level so far, or maybe even a little higher than that, and it can go at 1,147 level. That's quite a probability, and I would even put a pending sell order for the gold at 1,152 level with a narrow stop loss of 50 points or so. So from there, my target would be to look for the pair, the instrument to go back to 1,100, 1,107 level before we see another round of high towards 1,161, 1,170 level. So these are the targets that we will have. At the moment, I repeat again, the initial target, or initial, if you are long in your initial target, should be at 1,136 to 1,147 level, and from there you look for a downwards move to more or less 1,111 to again up, and then once again towards 1,100 level. Of course, you need to look at these other variables for the fact that we have a major event coming up, NFP figures, on Friday. So we will see a direct impact on gold. Talking of NFP figures, I have another webinar on Thursday. We will discuss about scenarios for NFP, and we will also share about the opportunities or strategies that we will have for the NFP figures. That being said, for NFP, if you don't make it to that webinar, just make sure to focus on USD Japanese yen and gold, for the fact that USD Japanese yen is the best performing tradable instrument. So quite often, most of the hedge funds who are trading Forex actually just focus on USD Japanese yen and gold to take the most benefit of the market. So this calls for the end of today's webinar. Thank you very much for watching it. And if you have any questions, feel free to comment now. In the meantime, today's webinar was sponsored by Trio Markets.